Hi folks, part 3 from chapter 8. So here we're going to take a look at employee versus independent contractor. By the way, a lot of folks play around with this. So by the way, I think there's like 15 criteria, but the primary question is this. Here's a primary question. And like I said, these 15 questions come to establish this. Who has control over how, when, and where the work is performed? Okay? And the reason why, there's tax differences here. So a lot of companies, what they try doing these days, they hire independent contractors for a couple reasons. Number one, not paying them benefits. And number two, you don't have to worry about the FICA. Okay? And the big deal is right here. Okay? So independent contractors, they're not paying FICA, Social Security taxes. Also, they're generally not taking out federal withholding tax. So people that work as independent contractors, they wind up having to be concerned with, did they pay enough tax in? Then what also happens is the deductibility of expenses. So for AGI expenses, if you have your own business, you can deduct those expenses. Or from AGI, these change depending upon which one you are. And the employer portion of self-employment taxes. Okay, so all those come into play. But like I said, people play around with this all the time. Okay. Now, tax credits, we've mentioned these before. The reason why tax credits are so good is because they reduce tax liability dollar for dollar. Basically, it's like a tax gift card. Okay. So they're really good, but of course, the government has their rule about how these go. And they basically use three categories: non-refundable personal, refundable personal, and then business. Okay. And by the way, we'll see later on they actually come out in a certain order. Okay. So let's take a look. Okay. First, non-refundable personal. An example of that would be the child tax credit. Okay. So it's $2,000 for each qualifying child under the age of 17, and they're your dependent. Okay. Notice this is partially refundable. Partially refundable. Okay. $500 for qualifying dependent. These are non-refundable. And by the way, there's a phase-out amount, not a percentage. So, and by the way, the child tax credit, that's one, right now with the election going on, and, they talk about increasing that. But this jumps all over the place. $2,000, $4,000 during COVID. Now I heard they're talking about $6,000. But anyway, partially refundable for one, non-refundable for another. Okay. Child independent care, another non-refundable. Child independent care, or if you're disabled, dependent under age of 13. And again, this one's based on expenditures to provide care. Okay. Maximum $3,000 for one, $6,000 for two. And then it depends on the AGI. So if you take a look in the book, so again, non-refundable personal, and this is basically child care, or it's a deduction, you're paying child care, or, if you have a disabled child, something like that, works for that as well. Okay. By the way, here's that exhibit. Okay. And notice here, if your AGI is this, but not over this, then the percentage is 35. And notice it goes down here to 26. Okay. These are the credits. Again, these are pretty low numbers here. Okay. I don't know if it goes any lower. Look at this. You're talking $33,000. Look, $33,000. I don't know where that's going to get you. I don't know. Looks to me like you need a lot more help than what they're offering here. That's all I can say. All right. American Opportunity Tax Credit, more non-refundable personal. Okay. These are for higher education, first 4 years of post-secondary education. For eligible expenses and institutions only. So it's applied per student, okay, and it can be the taxpayer's dependents, third parties, okay. So 100% of the first $2,000 of eligible expenses and 25% of the next $2,000 for a maximum credit of $2,500. $2,500 maximum credit. And again, phased out on AGI, and 40% is refundable. And again, there are some restrictions. So you could potentially get a refund of some of this money. depending upon, and then remember, it's phased out based on AGI. So the higher your AGI, the less chance you have of getting this. And again, typically, we don't have to look it up on charts because on the software, it knows the AGI and therefore calculates it for you. Okay. Another non-refundable is lifetime learning. This is another higher education credit. Okay. This is for any course of instruction used to acquire or improve the skills. Includes professional graduate school, continuing education. Apply per taxpayer. So MFJ is one taxpayer. 20% of up to $10,000 of eligible expenses. So $2,000 maximum right here. And then notice, again, phased out based on AGI. By the way, that's why the 4 AGI deductions are the best. Okay, because they lower that AGI. And you could see some of these deductions are dependent upon AGI. Okay. Other ones, education credits. Notice you can take American Opportunity for one dependent and 4 AGI deduction for another one. So education credits. Okay. So if you deduct the AGI education expenses for someone, no education credit will be allowed for that person. So you could use one for one and one for the other. All right, here's an example, American Opportunity Tax Credit. Courtney paid $2,000 in tuition and $300 for books for Ellen. She attended University of Missouri, Kansas City. What is the maximum American Opportunity Tax Credit before phase out that Courtney may claim? Okay. So $2,075. Why? The first $2,000 is 100%. Okay, and then they spend another $300. 300 minus the $2,000 times 25%. There's your $75, and here's your $2,000. Okay, pretty straightforward. Okay, it says here how much would if claim on her return if she were married and filed a joint return and her husband, assuming the couple's AGI is $162,000. So now it depends upon the phase out. We'd have to look what are the phase out limitations. Okay, so here's the American Opportunity Tax Credit before the phase out. Their AGI is 162. Phase out threshold is 160. So the excess AGI is $2,000, right? Now the phase out range is, so at 180 they would get nothing. So 180 minus 60, right? That's the range right there is 20,000, okay? So 2,000 out of 20,000 is 10%. 10% times that amount is 208. So this is 10% times $2,075, and they round that off to $208. So now they get this. Okay, so let's say this was $20,000, right? So here it's 10%. Let's say it was all 20, right? Then you'd have 100% of that amount, and so you get 0. So anything if you're above 180K AGI, you get zip. Okay? All right? Again, that's why the AGI credits are important, the 4 AGI. Okay? All right, earned income credit. This is a refundable personal credit. This is essentially a negative income tax. Basically, the government is giving you money. Essentially what they're looking at is the amount of income you've earned, the size of your family. So you have to get this, you have to have earned income. And the key is you got to make just the right amount, okay? You got to have at least one qualifying child, okay? And we're going to take a look at the next one. Take a look at these numbers here, okay? So look, if you have 3, let's say you have qualifying children, you have 2 kids, right? Maximum earned income is $17,400. Now, don't ask $17,400. I mean, with 2 kids, I don't know what you do. Take that by the 40% here, right? Gives you a maximum credit of this. The phase out for the credit, AGI over earned income is greater than this amount, right? So phase out percentage is 21.6%. So basically you can make up to this amount of money, okay? No credit when AGI is greater and exceeds this amount. So anyway, the bottom line is, if you're getting this, you're definitely not because you're rich, okay? All right, folks, going to stop it right there. We'll be back with part 4 in just a minute.